So welcome to this video. In this video, we are going to discuss about management accounting and what are the uses of management accounting, and also about its advantages and limitations. So management accounting is a separate subject. It's not like it's like quite similar to cost accounting, okay, but it's not as same as cost accounting. And management accounting is very much different from financial accounting. So we'll be like discussing these things in detail in this video. So we'll start with the official definition of what is management accounting. So CAMA is the top body for management accounting. So they have given a definition like the process of identification, measurement, accumulation, analysis, preparation, interpretation, and communication of information. Okay, so what are the works done by a management accountant is he finds out what are the information required. With that information required, how he could help the company to operate better. Okay, so he identifies the information, he measures it, he collects the data, he analyzes like what is happening with the data, and then he prepares management accounting reports and he communicates that to relevant users. Okay, so this information is used by management. Okay, it's used by the management. So mostly management accounting is internal to the company. Evaluate and control within an entry, so and to assure appropriate use of accountability for its resources. Okay, so management accounting helps to create plans and find out how the plans are working, and how to control those plans. Okay, so all these things are helped by management accounting here. Management accounting also comprises the preparation of financial reports for non-management groups such as shareholders, creditors, regulators, and tax authorities. So predominantly management accounting is used only for the management of the company. Okay, so the internal parties of the company. But in rare cases, they also create reports which are useful for shareholders and creditors. For example, shareholders, management accountant help in preparing environmental reports, okay, or CSR reports, or corporate social responsibility reports, or integrated reporting, like that. And for creditors, how much cash the company has, whether it could make the payments in a proper way, like that kind of assurances, okay, that could be made by the company. Any assurance to be made, we need information, right? Company needs the information, so those information will be supplied by management accountants. Okay, in the same way, they can also help in regulatory agents and tax authorities. So management accountants are usually not involved in the preparation of in the direct preparation of financial reports, but they are helpful in preparing other management related items. Okay, something like CSR report, environmental report. Okay, that kind of reports they are helpful in creating also. Okay, so where is this concept of management accounting is helpful? Assume that you are studying a course, something like CAMA or CMA. Okay, or in India you have CMA. So there are like many courses here. So if you want, I'll just type it. CAMA is in UK, and CMA US is there, and there is also in India we had earlier called a CWA, Cost and Works Accountant, which is in India, but now they have named it as now they have named themselves as CMA only. They have named themselves as CMA. So all these bodies are creating management accountants. So their predominantly purpose is to create management accountants. So what do management accountants do? See, management accountants help in all these kinds of areas. So for example, a company wants to price. So pricing a product is not such an easy thing. We can't just copy our competitor and we can't price, right? We can't do like that. We have to find out a lot of things, right? So for example, to price our product, we need to see what is our cost and what is our competition. Okay, what is our competition? We have to get what is our profitability percentage that we want, what is our margin. Okay, and we need to find out what is the price the customers are willing to pay. Okay, and what are the features that our product offers in terms of the in terms of other products. Okay, so we need to analyze all these things before pricing a product. Okay, so that is a like very important concept here. So the second one is called as break-even analysis. So break-even analysis is helpful in determining at what unit the business neither makes profit or loss, or in simple case, when the companies will make zero profit. Okay, so break-even analysis helps a company to find out at what level the company makes neither a profit or a loss. So why should we find out this? See, we should find out this because if we are able to produce, if you are able to sell more than that units, for example, if BEP units, if BEP units is going to be 1000 and we can sell, okay, our sales can only be done up to 900 units. See, then that kind of product should not be like considered to be produced at all, because to reach neither a profit or loss, you will take 1000 units, and if you are producing only, and if you are able to sell only 900 units, then that kind of a product should not be sold. Okay, any unit sold lower than break-even point is a loss. Okay, so if you can sell only 900 units, it will lead you to a loss. If you can sell 1100 units, that will lead you to a profit. Okay, that will lead you to a profit. So you can even put it in a simple case like this: even if you sell 999 units, you will make only loss. Even if you sell 1001 unit, you will make a profit. Okay, if you sell 1000 units, you will either make a profit or loss. So this kind of analysis is useful in many cases. For example, you are opening a coaching center. Okay, you want to open a coaching center. So when you want to open a coaching center, you have to pay rent, you have to pay electricity bill, you have to pay the teacher salary. So all these things you have to pay. So assume that rent comes to 5000 and the electricity bill comes to 2000 and teacher salary comes to 10,000. Okay, or 13,000, we'll put as 13,000. So our total fixed cost, okay, our total fixed cost, see, we don't have any other cost other than this, so the total cost comes to 20,000. And if the price per student, or the fee per student, is going to be around 1000. Okay, then with 20 students we need to break even. The break even point is 20 students, because if we get less than this, we won't make money. If we get more than this, we'll make good money, right? So if we have 21 students, if we have like, what would be our sales? Our sales for, so if the company has 21 students, they will make around 21,000, right? The company will make 21,000, and if the students are going to be, and if the sales is going to be 19 students, the company will make 19,000. Okay, so at 20,000 they will break even. Okay, they will equal this cost, they equal this cost, and at 19 students they will make a loss. At 21 students they will start to make profit. Okay, so break-even analysis is like quite useful here. Okay, it's like quite useful. So next we'll move on to what is a key factor analysis. So key factor analysis is it's a quite different concept here. So I think we can discuss this in a topic when we deal about key factor. Okay, here we can't explain it a lot. The next one is product profitability. So each product has a different profitability. So assume that there's a cycle company. The cycle company will usually have different cycles and they sell the cycles at a different price. Okay, so they have a different cost and they have a different price. Which cycle is the most profitable? If you want to find, you, it's called as profitability, product profitability. Okay, so usually so usually uh, so usually financial accountants will not have that data. Financial accountants will have only correct data and they will store it. Okay, so to analyze it we need a management accountant. So the next one is cost benefit analysis. So cost benefit analysis is used in terms of not for profit organizations. So in India we call it as NGOs, okay, non governmental organizations. Okay, in abroad they call it in the terms of not for profit organizations. Okay, so not for profit is a better term than NGOs. So not for profit is, we can find out like uh, we can't find out the profit of a company because they don't, their profit is not their element or their main aim. So what we do is we try to find out what's the relation between the cost spent by the organization and the benefit that this organization gives out. Okay, so for example, if you take Blue Cross, okay, Blue Cross is for dogs and for all the animals here. Assume that they're going to construct a shed for horses. It's around 1 lakh. So because of constructing this, what is the benefit? What is the benefit here? So they could have constructed a shelter for horse, or they could have provided some water facility for all the animals in the area, or they could invest this in better IT systems in the company. So they could have invested in all these. But the question mark is, what is the benefit of all these? Okay, what's the benefit? So if the company just has like 1 lakh, okay, if the company just has 1 lakh, they have to invest any one of it only. Which one is the most ideal? Whichever one gives you the highest benefit, you can put the money there. So if shelter is going to only help the horses and only few horses are there, and IT systems are not that required for the company, then they could go for providing the water. Okay, so that could be the ideal thing here. So they might go with the providing water facilities for all the animals in the place. Okay, see here it doesn't work like a company, because companies usually have the profit, and companies, what they do is they try to find out what's the profit for each of these projects. So companies will try to find out what would be the profitability. So profitability, wherever it is high, they will do it. Okay, so they have the measurement of profit, but for not for profit, they do not have the measurement of profit. So they have to depend upon the maximum benefits only. So that's about cost benefit analysis. Cost volume analysis, we have to see it later. Client profitability analysis is each client, okay, similar to a product, okay, every client is also differently profitable. Okay, some clients are highly profitable, some clients are not highly profitable, some clients require more service and some clients require less service. Okay, so we can put it like this. Assume we have different types of clients. Okay, we have 1 2 3 4. Okay, we have 4 types of client, and the fee that they each client pays is going to be like 100. Okay, it's going to be same 100, and the cost required to service these clients, okay, in terms of customer care cost, emailing cost, or some other additional cost, is going to be different. For example, for this guy it's going to be 50, he is going to be 80, he's going to be 95, and this guy is going to charge around some 40. Okay, so this is our cost. So different customers require different service, right? Different kind of interaction and service they require. So if you take the profit for the client 1 would be 50, here it's 20, here it's 5, and last it is 60. Okay, so now what you could do is, okay, if you want to cut off any client, or if you want to like minimize cost, simply you don't service client 3. Okay, don't service client 3, because all he gives you is only 5 rupees extra. That's a profit, and because of serving him, okay, we are incurring a lot of expense only. So better don't serve client number 3. Okay, just stop serving him. Okay, because if you see the total income is 400 and the total expense is 265 and the total profit is 135. If we stop serving this person, okay, all that we lose is only 5 rupees of profit, but how much of cost we will save is we will save 95 of cost. Okay, so don't provide service to this guy. We could provide him service in case we don't have any other client. Okay, but the maximum clients that we could serve is only 4, and we have an opportunity to serve another client called as client number 5. Okay, he is coming there as a new client, and the maximum cost you will incur is 50, so we'll only have another profit of 50 means don't, and you can maximum service only 4. So stop this client and take this client as your new one. Okay, so this is called as client profitability analysis. So we have capital budgeting, I think we'll say later. Also even in terms of buy and lease. Okay, so buy and lease decisions are also helped by management accountants. For example, whether a machine should be bought or leased. Okay, that kind of decisions also management accountants help. They help in sales forecasting. So the sales department will give the data about what would be the sales, and management accountants will try to forecast how it could be in the future. Financial forecasting, they also help in budgeting for the entire company. They try to control the cost through standard costing, and performance measurement, how the company is performing, how the department is performing. That and all we can measure through management accounting. You would have read something called as a ratio analysis in your college or even in your school, ratio analysis. So ratio analysis is a very important concept with which companies measure how the management accountants measure how the company is performing. Okay, so then we have relevant costing, we'll see this separately. Risk and uncertainty in divisional performance measurement, division wise how the company is performing, and in transfer price. Okay, so transfer price is very advanced topic, we can't see it here, we could see it in another video. Okay, so what's the difference between management accounting and financial accounting? So why information is mainly produced? See, the management accountant information is mainly produced for the sake of internal use for managers and employees, and financial accounting is prepared only for the sake of shareholders, creditors, banks, and governments, for external people. The purpose of information management accounting is required to help in planning, controlling, and decision making. Financial accounting is useful for finding out what is the profit for the period, and what is the assets that we have and liabilities we have at the end of the period. See, legally management accounting is not required, it's only optional, and financial accounting is compulsorily required, because it is, if you are a public company who has got people's money inside the company, then they have to create financial accounts. See, there's no, in terms of format, management accounting does not have any particular format or anything. So you can prepare in one manner, okay, your friend could prepare in another manner, provided it helps the ultimate objective, it's fine. Okay, so every company has its own style of management accounting. The format for for financial accounting is quite given. Okay, so that is like in India you have Ind AS, okay, Indian accounting standards. Globally you have IFRS. So you have in India you have Ind AS. So globally, if you take globally, you have IFRS, and in US you have US GAAP. Okay, so you have, each country also might have their own accounting standards. Okay, and the companies have to prepare the financial accounts only on that terms. So nature of information capture in management accounting is both financial and non-financial. So it can capture uh, currency value. Okay, for example, like 100 kgs of raw material bought at 10,000 rupees. So it can capture both the 10,000 rupees, okay, as well as the 100 kgs. But financial accounting will capture only the rupees, okay, or the dollars. That alone it will capture. It cannot capture 100 kgs at all. Okay, so that's a drawback for financial accounting. And the time period is usually management accounting takes the historical data and it tries to predict the forecasted data in terms of budgeting, okay, or in terms of even in this case BEP, this kind of break-even point analysis and all. We saw that we took old information to predict the future information. Okay, so that's about management accounting. Financial accounting is mainly historical. It's only a record of all the old information. Okay, so that's about the concept there. So now we could move on to what's the difference between management accounting and cost accounting. So this becomes interesting because if you take textbooks, mostly what they will do is they will combine both these subjects together, cost and management accounting. Uh, but international authors and very good authors, they make a split between management accounting and the cost accounting. There's usually a huge difference. Okay, so what is cost accounting? Cost accounting is there to find out what's the cost of creating a product or service. Okay, see, management accounting is more than that. It tries to find out what's the cost of a product, at what price it could be sold, okay, how the company should be planned and how the company should execute its plans. Okay, in all manners management accounting will help. Cost accounting cannot do that. See, format, in cost accounting there are some standards. Okay, cost accounting standards are there. For example, in India we have CMA or CWA. Okay, they have changed the name. Earlier it was CWA, now it is CMA. So they have issued something called as a cost accounting standard. Okay, cost accounting standard they have created. So they follow that kind of rules. In management accounting there's no rules like that. Okay, nature of information is, in cost accounting it captures both the kgs, okay, liters, hours, as well as the cost of it. Okay, 10,000 rupees, like that also. But if you take financial account, management accounting captures financial, 10,000 rupees, like that. Quantitative, 100 kgs, 100 liters, 100 hours, like that. It also captures qualitative. Okay, what is qualitative? See, qualitative is uh, uh, something like opinion. Okay, opinion, customer satisfaction survey. Okay, whether they have given a high satisfaction or a low satisfaction, that is something qualitative. Okay, see, or 10,000 kg, 10,000 rupees of raw material, 100 kgs of raw material, and high quality raw material. This high quality or low quality can be captured in management accounting, but cost accounting doesn't bother much about that. And next one is time period. So cost accounting captures the old and it tells you what is the cost of the product or what's the cost of the service. That's what cost accounting can tell. But management accounting tells historically what this is, what's the cost, this is what the cost is being incurred, and this is what will happen in the future. Okay, so it's like three phases of time. So the next one is scope. So scope is, cost accounting is mainly about finding out the cost and controlling it. Management accounting is like much wider: budgeting, pricing, standard costing, tax planning, reporting to management, and all techniques. Okay, and all techniques of planning and controlling.